For us this week, the focus has been on consumer sentiment and also the labour market. So start off the week with the Westpac Melbourne Institute Consumer Sentiment Survey. We saw there was a bit of a disappointing result with a 4% decline in the month. That leaves the survey about 6% lower than where it was last November. And in terms of a level sense, at about 95, which is about 5 points below the 100 optimist, pessimist sort of midpoint, and really suggests that people are on net are pessimistic about the outlook. In terms of sort of what likely drove that index to decline in the month. Obviously, equities decline, Australian equities decline in the month. We saw the Australian dollar rally, and at the same time, talk around China was relatively negative. Added to that, we also had obviously sort of discussions about sort of whether we'll see a mid-year budget, a budget coming up, as well as a mid-year election as well. So all of that sort of added to, I guess, a more sour mood for the consumer. In terms of the components of the survey, we saw both family finances relative to a year ago, and also the family finances for the year ahead, both deteriorated meaningfully. And also on the economic outlook for the 1 and 5 year, we saw a deterioration there for both indicators as well. I guess on a positive note, we did see time to buy a major household item edge up, and also that people remain relatively constructive about the labour market as well, which is showing a sort of a trend improvement in that sense as well. So there's more reason to be optimistic about their job prospects and incomes, and therefore we hope that will feed through into consumer spending as we move through 2016. In terms of the housing market, we continue to see people remain quite optimistic about house price increases, so gains are continuing to be expected. That being said, that is impacting affordability, and this is particularly the case in states which have seen quite significant rise in house prices. So New South Wales is a key point there. So that's really flowing through into whether now is a good time to buy a dwelling. So that's both on an affordability sort of expectation or concern, as well as potentially about sort of whether we'll continue to see those same gains going forward. The other sort of major release this week, as I mentioned, was a labour force survey for the month of March. We saw a 26,000 increase in jobs in the month. That was all part-time driven. That's not really an outright sort of sign of weakness, in the sense that although we do like to see full-time versus part-time jobs, the part-time jobs are really coming about because of the industries that we're seeing the hiring in. So a lot of hiring is coming through in the retail space, as well as education and sort of tourism-related activities, and they tend to have a higher proportion of part-time jobs than full-time jobs relative to other areas of the economy. So that's not really a particularly outright concern for us. What was interesting, I suppose, in the release was that we had been expecting the unemployment rate to rise as participation increased. We didn't see that. Participation stayed flat, and the unemployment rate actually edged back to 5.7%. For the RBA, this is quite a positive sign, although there is the risk that participation will rise in coming months, and that might lead to the unemployment edging up. For now, they can actually look and say, well, the unemployment rate is meaningfully below 6%, and indeed there is a modest downtrend in place for the unemployment rate. So that'll give them quite a degree of optimism in terms of what the growth outlook might be as we move through to 2016 and into 2017. They'll also take a positive sort of sentiment from the NAB Business Survey, which was out this week as well, and showed very constructive outcomes for both conditions and confidence as well. That would be expected to feed into further employment gains. Just before we conclude for the week, I just note also across in the US we have had some inflation data come out. That was a little bit disappointing, but the more sort of major point to note is around sort of where the sort of underlying or core inflationary pulse is at the moment. On a PCE basis, it's running about 1.7, and on a CPI basis, about 2.2. So you're getting to a point where you're sort of around that 2% medium-term inflation mandate that the Fed has. That's really emphasising that although we are still seeing sort of softer outcomes in inflation on and off, and we are still getting the negative impulse coming through from energy and from the US dollar, that there is justification on the inflation front to continue to edge forward and away from the lower bound and provide sort of further rate hikes to that economy. So we continue to expect we'll likely see 2 further rate hikes this year in the US, and that this inflation data doesn't really preclude from that coming through, but it is really going to depend on what we sort of see in terms of the activity data, and also how those global risks play through, which obviously from recent communications have become much more front and centre in the Fed's discussions. Looking forward to next week, it's actually a relatively quiet week. For Australia, we do have the Westpac Melbourne Leading Index, and we also around the globe have a number of other smaller partial data, including some housing data for the US. We'll see you next week.